Very good. All right, welcome everybody. Welcome to tonight's Zoom call at 8. My name is Julianne Peterson. I'm with Old Capital Lending. We closed $1 billion last year, a couple last years, twice, over $1 billion in loans. So we're happy to help with any of your finance needs. Today is April 21st, and I am super delightful that you guys are here. And I want to thank Daryl for last week, for covering last week. Thank you, Daryl. You did a great job. I appreciate it. Yay, Daryl. So I'm your host tonight, and we are here. I want to go over, and there are some real quick visits with the new people. So Steve is new. He is from Houston. So everybody, this is Steve.
Hey. Yeah.
Now, Jeffrey, you're new. I saw you on, you're a new mentoring student as well?
Are you talking to me?
Can't hear you.
Oh, can you hear me?
Yep.
Yeah, I'm a new mentoring student with Drew.
Great. And where are you located?
I'm in Los Angeles.
Well, so that's great. I'm in San Diego.
Okay.
So anytime you're down, we do a meetup in San Diego. So come on down.
I appreciate that. Thank you.
Yeah. Who else is new? David. Is it David?
Yes, Davide.
Davide.
I am new.
Where are you located?
Columbus, Ohio.
Great market.
Yeah, it is. Yeah, this is my second Tuesday Zoom call. I think I missed the last two, and I did the third one ago. So, and I am in the Shift 30 group too, trying to go through that.
It's great.
Which has been a great experience.
Yeah.
Just keeping an eye out, still making connections, and building my network, basically.
Excellent. Well, thanks and welcome.
Thank you.
Let's see, who else is here? Bernie is new for us. He is also a mentoring student. Bernie is also in San Diego County. Bernie, are you working on anything?
I guess I am. I had 3 deals come in today that I need to analyze. And so I'm in Augusta, Georgia is kind of my area of emphasis. And I put in 1 LOI. Don't think it's gonna fly, but hey, we're continuing on.
Good. Yeah, it's uncertain times, and we're going to go over some more of that. Last week, I pushed over some paperwork regarding Freddie and Fannie guidelines. So if any of you didn't get that, please reach out to me. I'll forward a copy to you. I try and keep you guys as much up to date as I possibly can. We also saw Freddie. Their rates dropped last week, about 25 bips. So, you know, again, there's a lot of uncertainty in the market, and so we're still seeing deals getting done, but they're going through the rigor, a lot of underwriting. So, all right, Nate, thank you for showing up. Great to see you.
Good to see you too, Julie. How are you?
I'm well, thank you.
That's
all right.
Good.
Anybody else? I see Paul. Welcome. Good to see you, Paul.
Hey, Julie. Good to see you.
Hey, congratulations on that deal you closed. That's
Thank
great.
you.
Well done.
Appreciate it.
Yeah.
Congratulations.
Mauricio, congratulations on the baby again.
Thank you, Julie.
Thanks for joining us.
Thanks for having me.
Yeah. Now, before we get started, I wanted to check in with you real quickly. Is there anybody that is working on something that needs some feedback or has some questions? Let's use the next 5 to 8 minutes on asking any questions. Anybody?
Well, since nobody asked a question, I'll go.
Yeah.
I had a deal in North Carolina a few weeks ago. We submitted an LOI. We haven't heard anything back from the brokers until this week. They called us back, and they're telling that the seller has updated their financials due to the COVID-19, and they're asking us if we wanted to look at the deal again. So I was just wondering, I talked to some other operators from South Carolina, North Carolina, I think a couple of weeks ago, and they told me that nothing has changed in the market, but I wanted to see if anybody else here has experienced any changes in North Carolina markets, if there are any moves, price drops or anything like that that they've seen or aware of. We're gonna, of course, reanalyze the deal, but I just wanted to see what everybody else's experiences are.
Julie, can I mention regarding the deal that I was working on? Nothing really happened. The seller sent a message saying that he was holding firm on his decision to not give us the financing contingency. That was a week ago. Since then, I've kind of just let it, just kind of let the dust settle. So I haven't really contacted them. I'm not sure if I'm doing good or bad. I feel that if I continue to push, it'll just completely kill the deal. I'd love to get some feedback. I'm just letting time go by, hoping that in a week or so the seller would come back and say, hey, you know what? Maybe we can work on the financing contingency and move forward with the deal.
Yeah. All right, let me first take Tim's question. Anybody have any feedback on South Carolina? It was South Carolina, right, Tim?
North Carolina.
North Carolina.
Charlotte.
Anybody have any feedback on Charlotte?
No, none here. South Carolina did well, 100% collection in March, and we're about 97 right now in April, and that's in South Carolina. So I'm hoping that's continued to go that way. May, I think a lot of people are very concerned about May and going forward. You know, but we shall see.
That's great, great feedback. I have a shopping center in North Carolina, and you know, occupancy is down and collections are down. I think it is what it is, and certainly, you know, using some of our reserves to make payments on that. We're not, you know, getting paid out on our distribution. So I think it's pretty standard across the board. What I'm seeing on my LPs is that as the month goes further and further, that our collections are becoming better and better. So I am encouraged on my deal, which is a couple deals, but the one that I've found most interesting is the property that we are in had started out with lower income collections and now surpassed the B. So I was hoping, I was really surprised that they were slow to collect on A's. That was just real strange. So, and then let's shift to Mauricio, and then we're going to get started. Mauricio was with us a couple weeks ago and decided to jump out of a deal. He had brought it back alive. I don't know if you guys remember the story, but he's walked away from it again, and just looking for feedback, I guess, Mauricio, on that as to what the direction is. You want to, if they're going to come back?
Yeah, at this point, I think all the feedback that I received from the group and from different operators, even my mentor, if there's no financing contingency, there's no deal in this market. And that's basically what the seller came back with. But the seller is still pushing for us to find some other type of financing, recourse loans, and so forth, things that I'm not comfortable with. But at this point, I haven't really gotten back to them, and I don't know if I should call them and email them and say, hey, by the way, we're definitely not moving forward under those circumstances, or just let some time go by and hopefully he'll, you know, come to an agreement with us regarding the financing contingency. But at this point, I haven't really finalized. I haven't really taken that step to tell the guy, look, we're definitely not moving forward. I'm just kind of letting time go by, and that's what I'm asking for feedback. If I should just talk to them and get a yes or no, or just let the dust settle.
Chris Bowen has an idea.
I don't think you need to tell him. I don't think you need to shut the door on it right now. Because really what you're doing is you're working diligently to find some financing to make the deal work. You don't need to say no right now.
I agree. That's how I feel, Chris. Thanks.
But
Yeah.
but
I mean, 'cause
Chris,
if somebody came to you in 3 days and said, "Yep, we've got the financing you need," you would go forward. I mean, if that's what you wanted to do. But the idea of just saying no right now, and the other thing too, though, is you don't really know what's going to happen. Whether, you know, they may shut the whole thing down wherever that building is. They may shut it down and you can't close anyway.
True. Good point.
Mauricio,
Yes.
maybe you did this. I don't remember you saying it last week or before, but did you ask him why?
Oh, thanks, Daryl. I had already asked why, and
Okay.
I didn't want to take too much time during the call, but I know the reasons why he's selling, and basically, if he doesn't sell, he'll just try to refinance. I know he wants to sell, and what I've heard from his attorney and his lender is he's a little bit difficult to negotiate with. Apparently, there's another party that already walked away from the negotiations. So that's the feedback.
So is that answer to the why because of why he doesn't want to give you finance contingency, or is that answer to the why is because of why he want to sell? See?
Okay, I see. Yes, I
I'm
see.
saying my question is, and I'm coming at you from a commercial guy.
Mm-hmm.
Anytime, I'm gonna play both sides of the fence. I'm gonna play commercial side. I'm gonna play investor side. From the investor side, I'm gonna put in for a finance contingency. Now, from the commercial side, I'm going to say no. From the investor side, I'm going to say why. See what I'm saying?
Mm-hmm.
Then from the commercial side, I have to give you an answer as to the why of the no on that finance contingency. There has to be a reason. So if you could get to the reason of why he doesn't want the financial contingency, then you may be able to shoot up underneath, say, okay, now I know why why he's saying no. Now let's see if we could work around this or go and take another route. It may be a little situation, maybe a problem. Can you talk directly to him?
I don't have his contact information. I
No.
can get it, but I
Go call, say to the broker or whoever. Say, I would like to have a meeting with him directly. And all three of you. Don't try to cut the broker out because you're going to have a problem. Include the broker and say, listen, I would like to talk with yourself. And if the broker says no, what are you going to say?
Why?
Why? Okay, and I'm telling you, I'm telling you from that side of the fence. Okay? Ask why.
Mm-hmm.
And if he says, well,
great.
That's not, I can't do that, say, yes, you can. Because you can.
Yeah, to Daryl's points, that actually works because the broker wants to sell the property as much as you want to buy it if it's a good deal, right? You know,
yes.
So get in front of the seller. You're no longer just a name on the paper. You're now a person.
Yeah.
Right. And as long as you just talk to a man to man, man to woman, whatever the case may be, right? I think it gives you more leverage as far as negotiating instead of just sending things back via email, phone calls, so on and so forth. So I think Daryl got a great point. My partner Heath Jones and I, we connected with a seller that way. We talked to the broker, and broker connected us, and it's one of the best things we ever did. One of the strongest relationship we ever created with the seller so far. And we didn't get we played bridesmaid on that property. We didn't get that property, right? Because somebody else made a higher offer, 1031 exchange with a shorter timeline closing, but we still maintain a relationship with the seller, and it's great potential that he will be one of our future investors. So to Daryl's point, it's, it could be a win-win situation. You don't get this property, but later invest with you. You can never tell.
Yeah, that's great. Thank you, guys.
We care about you, Mauricio. All right. we're here because we want to listen to our next speaker today. I'm super excited. I have been working with Chris for a little while now, and so Chris Nebenzahl is our next speaker. He is an editorial director at Yardi Matrix. He's responsible for overseeing market research and data analytics, as well as an editorial composition for Yardi Matrix, commercial property executive, and multifamily housing news. He facilitates the expansion of the Yardi Matrix reporting suite and provides in-depth analytical tools for clients across the commercial real estate industry. His focus includes, and this is why you're here, data analytics and reporting for the multifamily, office, self-storage, and industrial asset classes. This is the guy, you guys. Before joining Yardi, Chris served as a portfolio manager for the Bank of New York Mellon, managing fixed income portfolios for municipal and public sector clients across the United States. He holds a bachelor's degree in economics and a master's degree in finance. Both are from the University of Denver. He lives in Denver. He's here tonight. Chris Nebenzahl. Thank you so much, everybody.
Great. Well, thank you, Julie, and thank you all for allowing me to be here today. Julie, I appreciate the introduction, and I know that was a somewhat of a wordy introduction, but what does that all mean? Data, what's the importance of data when we're looking at markets, when we're looking at investment properties, and so forth. And that's really what I'm here tonight to share with you all, how we can use data, whether it's a Yardi or anyone else, another data provider, to really dig into the background of our deals. So I'll go ahead. Can everyone see my screen okay?
Let's see, I see it. There you go. I see you and I see the screen.
Okay.
And then there you go. Perfect.
All right, let's, all right, how does that look now?
Great.
Before we get going?
Perfect.
Great. One thing I will say, if anyone has any questions, I can't see any of your faces now. I'm just looking at my presentation, but please jump in, please blurt out. I'd be happy to answer questions as we go along. And it, excuse me, it'll actually give me a good break to pause. I was telling Julie before the call that I'm fighting a little bit of a bout of seasonal allergies. So if I sound a little stuffy, I do apologize for the clarity on the call today. But
hey, Chris, would it be helpful to do a chat room? Just have it put up in the chat?
Let me see, I could.
I can read the chat if someone posts it in there.
Yeah, that would work well, Julie.
Okay, let's do that, guys. Everybody, again, if you would put on your mute, and if you have any questions, put it in the chat room. Thank you.
Great. So I want to start off with where we are today. We know there's a lot going on with the coronavirus. Certainly that's impacting the entire economy as well as the real estate economy. So what I'd like to start with is just kind of, what does the financial market look like? Obviously the financial market and the economy is the underpinning of the real estate economy. And a lot of what we do, whether it's getting financing, whether it's investing in property compared to equities or bonds, all of this really starts with what's going on both domestically and internationally from a financing standpoint. So we know that the stock market crashed in March. We know that the 10-year has been on a pretty steady decline downward. Now the 10-year doesn't necessarily track as close to our financing rates in the multifamily world as it once did. I expect that to go back to a normal level once we're able to get a little bit of a grip on what's going on from a healthcare perspective and from an economic perspective when we think about all the jobs lost in the services sector, in the retail sector as well. But while financing rates from Fannie or Freddie or any of our private lenders may not be as closely tied to the 10-year, we still want to keep an eye on what that 10-year is doing. I think it was at about 57 basis points today. again, record lows. And I expect that 10-year to stay where it is. I don't see a whole lot of inflation, which is what would drive that 10-year treasury rate higher. And so once we kind of get back to that normalcy again, once the economy levels out, I do think the 10-year will come up a little bit, but it'll still present a very good investment opportunity and a very good financing opportunity for us. So what is going on kind of behind the scenes? Well, the Federal Reserve is in whatever it takes mode. They will do absolutely anything they need to really backstop the economy. Coming out of 2008 and 2009, they created this new program called quantitative easing, where they pumped a ton of money into the economy by buying treasury securities and mortgage-backed securities. And that was unprecedented at the time. And it's really what saved our economy from going into a Great Depression. It was, at the time, the greatest recession any of us probably have seen. Now, that's certainly been trumped by this current recession that we're in. The Fed has gone above and beyond what they did the last time. They basically said unlimited quantitative easing. We'll purchase as many treasury securities and as many agency mortgage-backed securities as is needed. And we'll also use some of these other lending and borrowing platforms to continue to backstop other things like CMBS. They have a credit facility for consumers and businesses. So the Fed is really entering the market. Their balance sheet is exploding right now. And it's really one of the factors that's keeping us out of a huge, huge downturn. Now, what's the, excuse me, what's the other thing that's keeping us from an even greater downturn? Well, it's the fiscal stimulus. The first bill, the CARES Act, was passed a couple weeks ago now, and it was by far the largest spending bill that the US has ever had, and far larger than any other country, both on a percentage of GDP basis as well as on an absolute basis. As you can see here, a lot of that money went to individuals. That's where we are. Julie, can you hear me okay?
Yep. Can you guys hear him?
It says I was muted.
Yep, you're good now.
Okay, great. So drilling a little bit deeper into the CARES Act, you see bailouts for the airline and cargo carriers. You see the small business loans, the PPP that we've heard about in the news a lot. Now, the $350 billion has actually already been allocated. Just today, they announced another $480 billion. So this fiscal stimulus is now closer to about $2.5 trillion, close to 10% of GDP overnight in a stimulus package. So really unprecedented things going on, both from a monetary policy side and a fiscal policy side. The unemployment claims and unemployment benefits have been, again, backstopped by the government. And this is really an essential thing that we need now, especially if we're operators of property. As many of you heard at the beginning of the call, collections seem to be doing okay. The NMHC, the National Multifamily Housing Council, has been collecting data, and about 85 to 90% of all collections for April have been paid as of April 12th. A lot of people in the industry were concerned with April collections, but it seems like April is doing okay. May is right around the corner, about a week and a half from now. So again, there's more concern, especially because a lot of this money has yet to be paid out. So something to keep an eye on in terms of collections, but given how much stimulus there is in the economy, as long as that money is paid out and hopefully paid out soon, we should be okay from an operations standpoint. Now, that's good news for all of us operators out there, but perhaps varying news for the investors. One of the things that's part of the CARES Act is that any Fannie and Freddie loan, any loan backed by Fannie and Freddie, they cannot evict and cannot foreclose on those loans for about 120 days. So the distressed opportunities, I think they will be there. I think we will be entering a buying phase, and I hope that a lot of you have capital ready to deploy, but it's not going to be immediate. We're not going to see the turnover and the distress in May or June. It'll probably be more like August, September, October. And so who's really getting impacted right now by the economic slowdown and the coronavirus? Well, it's mostly hourly employees. As you see here, the hourly employees, the hours worked by hourly employees has really plummeted in the middle of March. It leveled off, and this data I know is a little bit old, but that trend has continued through the first 3 weeks of April. And I don't expect that to continue. I don't expect that to reverse until we really start to open up the economy again. Now, I know a couple of states, Texas, South Carolina, Florida in particular, have taken early measures to start reopening their economy. But I think this is going to need to be a widespread nationwide reopening before we really start to see the economic engine pick up once again. So we did a little bit of analysis, now diving into the markets. And this is where I'll start talking about, how we look at markets, what drives a specific market. If you're looking to get into a new market, or even if you're just looking to compare the market that you are in, perhaps compared to a neighboring market or another similar market. So we looked at the top 10 and bottom 10 markets for the percentage of jobs, the concentration of jobs that are most at risk. And so we identified the 3 sectors most at risk to be travel, leisure, and hospitality, mining and construction. Mining is also the sector where oil extraction falls. And we can talk about oil in a bit, certainly unprecedented times in the oil industry on the domestic side and internationally. And then the third sector most impacted and most at risk is the retail and trade sector. So you see some markets here on the left: Las Vegas, Southwest Florida coast, Orlando, Houston, Miami. Markets that have high concentrations of leisure, of retail trade, and then in markets like Houston, San Antonio, a little bit more of the oil dependency, mining, construction, and places like Vegas where a lot of these come together. Vegas certainly has a high tourism industry, but also a large construction industry, large retail trade industry. So a lot of jobs being impacted right now. Almost half of the jobs in Vegas are what we are considering at risk. Now, on the flip side, some of the best positioned markets are some of the older markets: Boston, New York, San Francisco, DC, what investors often call the primary markets or the gateway markets. Now, these markets, they certainly do have a high concentration, and because of the population, they actually have the most absolute number of jobs in in industries like tourism and like retail. But because of their diversified economy, they're a little bit better structured to weather a downturn right now. Now, we'll talk a little bit more about the gateway markets in a bit when we talk about growth markets versus kind of stabilized markets. But as we're thinking about the immediate shock today and over the past month and probably over the next month to 2 months, these markets on the right seem to be a little bit better positioned because of the diversity within their economies. This is the same data, just drilling even deeper into the market level. So the markets with the darkest red are the most at risk. And again, not only do you see Orlando and Las Vegas, but you see a market like West Texas, Midland, Odessa, the Permian Basin, and the oil patch, market that's really getting crushed. Now, a lot of the markets in West Texas have been strong growth markets, especially as the U.S. have become net exporters of energy, both oil and natural gas. But again, the volatility there, especially in the oil industry, is really going to hurt those markets. So speaking about oil, just for a second here, I know we saw the May futures trade negative yesterday. We've never seen the price of oil go negative. And oil's been incredibly volatile given the economic slowdown, less of a demand for oil. We can get, I think gas is $1.25 here in Denver, but I haven't driven my car in a while. So No need to be fueling up at the pumps. I'm sure a lot of you are in the same boat. So really an interesting time for the oil industry. As I mentioned, in the past couple of years, we've become net exporters. So we're pumping a lot more oil, we're exporting oil and natural gas. That's really been helpful for places like Houston, Oklahoma City, New Orleans and Shreveport, Louisiana, Pittsburgh, Denver, some of these fracking heavy economies. Now, places like Houston, they have been diversifying, strong healthcare presence there. Denver as well has a strong tech presence, but those markets will feel the pain, certainly of the reduced cost of oil and likely the shuttering of a lot of oil rigs and perhaps the bankruptcy of a number of oil-based companies. So before we continue on and talk really about what we look for and how we identify markets to invest in, any questions in terms of the economy, anything we're seeing from the coronavirus and how that might impact the real estate industry today, April 21st, as we see it now? Okay. So as it says here, what do we want to look for tomorrow? What do we want?
Chris, can I interrupt you for a second?
Sure, go ahead.
A question came in, how will all of the stimulus money affect the economy? Will we have inflation?
That's a good question. There is a ton of stimulus going into the economy. I don't expect there to be a lot of inflation for a couple of reasons. A lot of goods inflation is tied back to oil. What is the cost to ship goods around the world? What is the cost to produce goods? Both of those things tied to the price of oil and tied to the level of oil in the economy. So I don't expect to see a lot of goods inflation, at least not for some time. Excuse me. On the services side, what is driving services inflation? And that's mostly technology, keeping services inflation rather low. This is going to be a really interesting time coming out of the work from home, work remote, the fundamental shifts in the economy, especially for most office workers, because I think we're going to see a fundamental shift in the way people interact, the way people work. And oftentimes when there are holes like this, technology floods in to fill those holes and to support those industries. So I think it'll be really interesting when we look at industries like co-working, when we look at industries like the tech industry, just this call and Zoom. How have our lives changed with Zoom and GoToMeeting and WebEx and FaceTime and everything else in the past couple of weeks? I expect because of the rapid increase and the immediate increase in need for technology, that services inflation will stay relatively low. And you'll also see a lot of innovation on the technology side, again, keeping the services inflation relatively low.
Will it affect our dollar?
I don't think it will, because a lot of other countries are going through the same thing. Certainly when you look at the Eurozone, I expect there to be a significant recession in the Eurozone. We've already seen China's numbers come out. I don't really think any economy in any region is immune to this. So will the dollar fluctuate a little bit? Yes, I'm sure it will. But long term, I don't think it will have a huge impact on the dollar, because really all of the developed economies are borrowing. Yes, we're borrowing the most, as I said, on a percentage of GDP basis and on an absolute basis. So in the long run, our dollar might weaken a little bit, but I don't think it will be a major difference from what a lot of other developed economies are going through.
Okay, thank you.
Sure. All right. So let's drill into kind of the factors that we should look at when picking markets. So the first is just economics 101, supply and demand. Where do transactions need to occur as well? We'll talk a little bit about how to follow loan maturities and opportunities there, given some of the maturities that are coming up and where those are concentrated. Then we'll dive in a little bit to public-private partnerships, local amenities, and who your residents are on the multifamily side in terms of how you want to frame your view on picking a market. So the first thing that we look at, in the supply and demand equation is where are the jobs growing? Now I know this data is a little bit old, and I had just mentioned how at risk Orlando is, but over the past 10 years, and certainly going as recently as December of 2019, Orlando had one of the fastest growing job markets. A lot of the growth in Orlando was twofold. There was tech and healthcare coming in, and there was also migrant labor coming in from South America, from the Caribbean. So it was kind of this twofold job creation angle. Now this obviously has pulled back significantly in Orlando, but when you look at some of these other markets, Seattle, Dallas, Phoenix, Houston, San Antonio, Charlotte, Austin, what stands out to you? Well, it's not the Bostons, the New Yorks, the San Franciscos, the big markets that get all the hype, right? The fastest growing markets, both last year as well as through this whole recovery, have really been the secondary markets. The primary markets were the first to get out of the Great Recession, but the major growth has been in these secondary markets. Same trend taking place on the population growth side. Austin, Phoenix, Raleigh, Vegas, Charlotte, really strong markets. All of these markets have pretty strong tech bases. Austin, Raleigh, and Charlotte specifically. Charlotte has a very robust finance industry. So the tech and the finance and a lot of the intellectual capital-based jobs that have been driving the last recovery, and I expect to drive the next recovery, they're not stuck in San Francisco and Boston and New York anymore. As you see, all the markets here on the left side, Denver, Atlanta, Seattle with Amazon and Microsoft and Boeing, really strong job growth and population growth. And that's really one of the things, two of the factors actually to key on when you're thinking about demand. Now, obviously demand has to be in balance with supply. Just because there's demand in a market doesn't mean you can overbuild. And Denver, where I am, is one of the kind of poster children for that equation. For the past, I've been here about 12 years. For the past 9 or 10 years, Denver has been booming. New neighborhoods popping up, new jobs popping up, the extension of the Denver market, almost all the way down to Colorado Springs, which is about 60 miles away. But at the same time, the developers have rushed in, and here you see they're currently delivering about 5% of existing stock per year. Tons and tons and tons of new multifamily stock, almost all at the high end, are being built in Denver. Same thing with Austin, same thing with Charlotte. And again, these are the markets that I would say have some of the strongest demand potential, but they also have a lot of supply. So that's why we're not seeing outsized rent growth performance and superb occupancy performance in these markets. It's because there's a lot of new supply coming in. But where are we seeing the fastest rent growth? Well, look at a market like Phoenix, kind of middle of the road, 2.5% completions as a percentage of existing stock. Sacramento has been one of the fastest growing markets from a rent perspective, less than 1% of existing stock being delivered. Now, it's certainly hard to build in California. Anyone who's in California on the call knows kind of the development restrictions present in a lot of the markets. So that's another thing to kind of focus on. But Sacramento has some really, really strong job and demand growth fundamentals and also limited supply. So bringing that all together, kind of what does the performance look like? This is our year-over-year rent growth as of March. This doesn't yet reflect a whole lot of the impacts of coronavirus. I expect our April data and certainly our May, June data will show a lot more of what's going on from a collections and from a rent growth perspective. I don't expect there to be a lot of rent growth for the next 6 to 12 months. I think we should be happy keeping our keeping our residents happy and keeping our units occupied, it will protect us in the long run if we're able to just kind of keep things at bay. We won't see a whole lot of rent growth, but at the same time, we won't have to see rent declines and concessions because we need to refill the units. But again, going back to who's had the best growth, Phoenix, Seattle, Charlotte, Las Vegas, Nashville, some of the same markets where we saw really strong demand, really strong job growth, and also not crazy amounts of new supply. Again, you see Austin performing well, 3% year-over-year growth, Denver about 2.5%. So there is still demand, and demand will always push rents forward, but you have to kind of balance the supply and demand in these situations. And finally, where will the opportunities arise? And this is where we have to take a little bit of our supply-demand analysis that has been ongoing and will be ongoing and pair it with what's going on in the short term. What's going on with the coronavirus, what's going on with the economy. And so this is where you see the most loan maturities, or the units with the most loan maturities coming up in the next 6 months. So darker markets are where there's more loan maturities. And certainly, as we know in the multifamily industry, when a loan matures, something has to happen. Either they're going to refinance or they're going to sell. Most of the time, a refinance is available. Given what's going on right now and the tightening of the financial markets, the tightening of the capital markets, there might be an opportunity for investors who are well capitalized to jump in to a deal. Perhaps it isn't meeting its pro formas. Perhaps the seller or the owner is just a little skittish with everything that's going on, and there might be an opportunity to get a deal a little bit under market price. We haven't seen huge pricing corrections yet. I expect those pricing corrections will take place again more towards the second half of this year. But there will be opportunities to sharpshoot in certain markets, especially where there's a lot of loans coming due. So any questions before we continue on?
Yes, I have one question.
Yeah, please go ahead.
In the markets where there are no stay-at-home orders, have you seen any change in those markets, which is Arkansas, Iowa, Nebraska, and the Dakotas? They have no stay-at-home orders. Have you seen any change in those markets?
We haven't, no. I understand those markets have not officially implemented stay-at-home orders, but what we've seen is that for the most part, and those tend to be less densely populated areas as well, there has been a pretty strong public response. And I hope this is where we can go with the nation as a whole, where there may not have to be a specific order, but people are still being smart about staying at home. The economies are kind of naturally receding rather than being forced to recede, especially given how fast the virus has expanded. In some of these other markets, like you mentioned, the Dakotas, Iowa, Arkansas, I think people have taken pretty good precautions. And as a result, we haven't seen a whole lot of either growth opportunities or recession, I would say outsized recession indicators.
Thank you.
Sure, absolutely. So drilling a little bit deeper into markets and what really makes markets.
Julie's saying something.
Yeah.
Sorry, go ahead.
Yeah, Chris, I was wondering, is this information something that is shared publicly, or is this something that people would have to have an account with Yardi?
Yeah, great question. So we do publish a public report every month, just kind of giving an overview of what's going on nationwide. But any of the, excuse me, market and submarket and property level detail would require a subscription to our data service.
Okay, thank you.
Sure. So digging a little bit deeper into kind of what makes a market tick, what makes a city reach its critical point of success. And we really look at kind of 4 key factors. What's going on with public-private partnerships, how friendly of a business environment exists in the market, what sort of amenities are in the community, in the city, that would draw people there, and then how educated is the workforce. So we'll take a quick look at Austin. I've been talking a lot about Austin, but one of the keys that I focus on with Austin, and one of the real strong drivers of growth, I think, in Austin is the sharing of the political climate. So Austin, as many of you know, or any of you who are in Texas know, that Austin tends to be more of a liberal city within the Texas market, but Texas certainly is a very friendly business state. Low taxes, generally easy to develop, easy to start businesses, easy for companies to relocate. So that balance of a more liberal and more regulated city within a more business-friendly state is a really, I'd say, strong sign of growth. You can look at places like Charlotte and Raleigh in similar examples, Atlanta, Denver. Again, nothing against markets that don't have that balance, but those markets seem to be the ones that have grown the fastest. Very rarely do you have to worry about things like rent control and other highly prohibitive regulations in a lot of these markets. But they also generally attract a higher and more educated workforce. The educated workforce tends to be a little bit left-leaning, so they want a little bit more of a liberal location. But again, it's that balance between a more liberal-leaning city, still with a friendly business environment. And just looking at Austin's employment, very diversified. We've got educational and health services, a lot of professional and business services that incorporate some of the tech industry. Leisure and hospitality is a pretty strong presence in Austin and the Hill Country. And then you've got government, certainly with the state capital of Texas. So again, you want to look for more diverse economies. If any economy is tipped, the scales are tipped toward 1 or 2 industries, like they are in, say, Midland, Odessa, even Houston to some extent, Oklahoma City. That's going to be concerning, especially as you look at a downturn like we're experiencing right now. Also, it's really important to look at the demographics. So who's moving in, who's moving out, how is population growth doing? Again, I think Austin was the strongest market for population growth of the top 30 markets in the country. And if you look at this band right here in the middle, that's your renter population. A lot of people moving in that younger renter cohort, say 25 to 35 or 40. So really important to not only look at overall population growth, births minus deaths, in-migration, and international immigration, but who's going to be your renter? And that's really that kind of middle tier. And you can see that bulge in the Austin demographics data, really strong growth and really strong population pyramid, age demographic pyramid for where most of our key renters would be. Just a little bit on Austin rents. This is the past 9 or 10 years. You can see pretty steady growth. Their occupancy has kind of fluctuated. Again, as I said, there's been a lot of new supply. So the first wave of supply came here in late 15, early 16, and you saw occupancy really plummet. Supply eased back, demand remained. You've got Apple, you've got a lot of the tech firms that are opening up in Austin, and occupancy came back again. Okay, what the developers say, well, Austin's still hot, and they developed, and again, you see that occupancy starting to trail off. So again, it's all part of the supply-demand balance, but certainly with Austin, it's got the long-term growth drivers to see through not only this recession, but also be one of the strongest markets coming out of the recession. And I'll kind of wrap up here, going beyond just the market level. But we like to call these things intellectual capital nodes. Oftentimes in cities, there's an intellectual capital node in the downtown area, and then usually 2 or 3 or 4, maybe 5, depending on how big the market is, outside of the downtown area. And what creates an intellectual capital node? Oftentimes there's a university, oftentimes there's a collection of high-tech offices. So if anyone's familiar with the Denver area, the Boulder Broomfield corridor is one, the Tech Center, the Denver Tech Center. And if you look here in Austin, we've defined the two intellectual capital nodes as the Silicon Hills and Round Rock outside of the downtown area, as I mentioned. So you see a lot of job growth here, a lot of high-tech job growth, and a lot of highly educated workforce congregating in these areas. So from a multifamily side, you're also seeing a lot more rent growth, and for the most part, more supply growth. Generally, and some of these markets are not, or some of these nodes are not the most indicative, but you see general outperformance. So for example, the Austin Metro, over the past 5 years, rents grew 20%, supplies grew 23%. Silicon Hills, there was less supply growth, but outsized rent performance. And you see that occupancy change, occupancy stayed flat, while the whole metro, as I mentioned, receded about 70 basis points. Downtown, rent growth hasn't been quite as strong, but a lot of that is because supply growth has far outpaced the whole market. And the occupancy, not only did supply outpace the whole market, but occupancy actually did a little bit better. So when you're looking at markets, I would really focus on where within a market is there the intellectual capital base, and where do people want to congregate. So for example, Domain in Austin is one of those really hot neighborhoods and markets, or sub-markets I should say, and a lot of intellectual capital is being poured into that area. Silicon Hills, Round Rock, again, there are these pockets, these sub-markets that are likely to outperform based on who your core renter base is going to be. So with that, Julie, I will kind of finish my prepared remarks and really open it up to the group for questions.
Yeah, your mic is muted, Julie. Your mic, Julie.
I should be on now. Can you hear me?
Oh,
Nate?
yeah. Yes,
Okay.
I can hear you.
Okay, so,
But I had a quick question for you, Chris.
Sure.
You were mentioning the Austin market. Now, this is just my hypothetical view. I don't have any data backing it up, but I'm taking into consideration that outside of this, more people are saying to me, it's not more of an economic crisis than it is a health crisis that we're experiencing, right? So I'm following the money, and I'm seeing where the money is going, and the money is going to airlines and hospitals. And when I think of a growth market, I'm thinking, where are the seniors? Where are the hospitals being built? And when you say Texas, I'm thinking more of Houston, like with the Texas Medical Center being as huge as it is, and with $117 billion in bailout money, that's going to be huge opportunities for those kind of markets, especially along the southeast states like Florida and Texas and through the Smile states. That's why I don't have any data, but just following the money and seeing where all the jobs can be created based on that money, it's more of a healthcare crisis that we're experiencing than an economic one, because I think the banks are well capitalized. It's just trying to, kind of weed through the fog, so to speak. What are your thoughts on that?
Yeah, Nate, and I completely agree with you on the healthcare crisis versus the economic crisis. I think what we're seeing with the stimulus money is that it's really being forced in to hemorrhage the bleeding and to slow that healthcare crisis. The fundamental underpinnings of the economy, I think, will remain. Will we see a growth in healthcare technology? I think we may. That would probably be the industry that I would focus on the most coming out of this. But the markets you mentioned, like Houston and Florida, I actually think those markets, excuse me, those markets might struggle to come back because of the concentration of the virus there. their economies will likely be shut down for the longest. And yes, they do need the stimulus money, and the hospitals certainly need the stimulus money. They need to pay the doctors. They need more equipment. They need more testing. They need more access to capital. But I think once we see through this healthcare crisis, the economy should return to the fundamental underpinnings that were there, that were technology, that were finance, and I think you'll see a recovery in some of these secondary markets with strong tech bases that also don't have the density of a San Francisco, of a New York, of a Boston. Density is one of the big concerns right now with everything that's going on. And part of the reason that the disease is spreading so quickly in New York is because of the density. So not only are people working from home and can people work from home, but our company's not going to, excuse me, our company's not going to look more for secondary markets that have an educated workforce and perhaps go to a de-densified strategy rather than, you know, the congregation in a place like New York or DC or Boston or San Francisco.
Do you see rent control coming to other markets, Chris?
I do, and certainly before COVID-19 and the coronavirus outbreak, that was the talk of the industry. California, Oregon, New York, certain markets like Denver, Boston, places in Minneapolis. And I do think we're not going to be out of the woods in terms of our affordability issues and our affordability crisis, just because the government is, you know, handing out significantly larger unemployment benefits and also, you know, giving a check to most Americans. I do still think we need more housing, housing at the high end, housing at the lower ends, and unfortunately, I think one of the side effects is going to be a pullback in supply coming out of this. A lot of construction sites are deemed essential, but a lot are not, and so we expect we just reforecasted our supply numbers. We expect about 220 to 230 thousand multifamily units delivered across the country this year, down from about 285. So we do expect to see a pullback in new supply, and that'll filter out into the oncoming years as well. All that to say, the affordability issue I think will only continue, and I think you'll see more local pushback in terms of rent control in places where rents have grown the fastest. Now, we may get hopefully a 6 to 12 month reprieve if landlords hold back on rent increases. You know, what drives the fodder for rent control? Well, significant rent increases, right? The population is then upset with, you know, their rent increases, and there's more of a grassroots movement. As I mentioned, I don't think we'll see a lot of rent growth at the high end, at the mid tier, and at the low end. I think, and I would recommend that operators just kind of hold in place. That might give us a little bit more time on the rent control side, but I think at the end of the day, what really is going to pull the rent control argument back is if we're able to build more sustainable housing, build a lot more housing, and let the natural market forces really dictate what the appropriate rent is.
Do you have any idea of where the least likely there would be rent control?
Yeah, I would say the states where we won't likely see rent control are probably along the southeast into Texas, perhaps moving up into the mid-Atlantic and Virginia and places. But I think you'll also see rent control start to take shape in more local municipalities. So I know California was statewide, Oregon was statewide, New York was statewide. And in some of those more liberal markets, and also markets that have the highest rents, you may see statewide measures. But I wouldn't be surprised if you saw rent control in say, a Raleigh, North Carolina. Again, that tends to be a little bit more liberal within a more conservative and more business-friendly state. I would be surprised if we saw a statewide rent control in Texas, in Florida, in North Carolina. But you might very well see rent control at the local municipal level.
Now, are there any significant data points that we would want to look at for identifying new markets as May and June data comes through that we can see?
Yeah, well, I would again focus on the domestic migration and the population growth. I know the jobs data will be a little bit wonky for the next couple months. You'll see rapid declines, then you'll see rapid growth. You may see kind of a W-shaped recovery where it'll be rapid decline, growth, decline again, another growth. So just basing your analysis on where the jobs are going might be a little bit tough. But look at the overall trends. And again, people were leaving the Northeast and the West Coast long before coronavirus. There were more restrictive tax and business environments. There was better weather in certain other markets. There was cheaper cost of living in other markets. So I would look at, where are people going? Where are young people going? And the great debate, I think, over the next 2 to 3 to 4 years, certainly coming out of this, we saw a lot of people and a lot of generational dispersion over the past 10 years. A lot of millennials who might have grown up on the coasts found markets like Austin, like Denver, like Raleigh, like Minneapolis, and chose to put down roots there. Will their parents, will the baby boomers follow their kids, or will their kids be pulled back home? And we don't have data. I don't have a crystal ball, but if we are watching what has been going on for the last 5 or 6 years, the overall trend has been south and towards the center, where you see people from California moving to Phoenix, moving to Las Vegas. You see rapid population growth coming out of the Northeast and into places like North Carolina, Atlanta, Florida, and then a lot of people moving again to the interior markets like Denver and Nashville as well.
You guys were past 6, so I want to make sure that we've got Chris's information. So Chris, could you flash that back up?
Yes.
Chris
absolutely.
is offering if you're interested in finding out what the top markets are, to send him an email. So Chris, if you could share that one more time. And
Sure.
that would be the last screen.
Are you able to see my screen, Julie?
Yes. Yep.
Great.
So chris.nebenzahl@yardi.com. So before you leave, Chris, everybody got that down? Take a picture. Yeah, let's get a quick pitch on Yardi.
Sure.
So just a couple things I want to make sure that I'm clear about with everybody on board. So everybody's, for the most part, is in their, working on their first deal, maybe has one deal. I'm not sure if everybody has, they're into the second deal, but for the most part, they're doing the work themselves to capture the data, which is time consuming. And as I've said before, what we've done in the past 10 years is not what we're going to do in the next 10 years. We really have to be data driven moving forward. So I want to know, tell me a little bit about it, what you're working on, how we can get into a Yardi package.
Yeah, great question. And I wish I had just created all of this data myself, but certainly it comes from somewhere else. It comes from a larger database and a larger foundation. But Yardi Matrix is the data division of Yardi Systems. Some of you may know Yardi Systems from their property management software or their internet listing service. But I run a team of researchers that do just what we just talked about. What's the next hot market? If you already know your market, where within that market should you be investing? What's the hot sub-market? And so please reach out to me. We sell our data on a subscription service, and for many of you, it may be a little bit out of your price range if you're just working on your first or second deal. But I love talking to people about markets. I love sharing data, and we're able, my team specifically, the institutional research team, is able to do kind of one-off projects. So if there's a deal that you're working on, and you want to see more on the submarket or the market, or even drill down into the property level data that we have, please reach out. Please give me a call. I have a team of about 10 people, and that's all we do all day, every day. We look at markets, we look at properties, we look at submarkets. So if there's anything that we can help you with, even if it's just on your first deal or your second deal, I'd be happy to do that, and my team would be happy to support that as well.
Chris, can you tell us about what kind of pricing it would look like on an individual subscription, and how many cities does that encompass? Tell us a little bit about that cost-wise.
Yeah, absolutely.
I am gonna say most people are looking at least one, maybe two, perhaps three. How do they do this? Tell me about that.
Yeah, so the pricing, if you're just looking at one or two markets, we sell our annual subscriptions for about $3,500 per market. And that gets you the submarket data, the property level data, expense comps. You can find out the owner's contact, the property manager's contact. So I know, Mauricio, you were talking earlier about having access to the seller's information. That's something that you could get out of our database. As you scale up, if you have more than 10 markets, it probably makes sense to do a national subscription for $25,000. And so I know that it's not a cheap product, but if there's interest, please reach out. Our sales team's always willing to work with prospective clients. And like I said, I'm not with the sales team, I'm more on the research side. So I'm always happy just to do a one-off analysis here and there. I'd love to build more of a relationship and just find out what kind of deals all of you are working on as we perhaps come out of the coronavirus and enter a more opportunistic buying period.
So Chris, your competition is CoStar, is that correct?
That's correct. Yeah, CoStar, Axiometrics are kind of the two main, or CoStar, Axio, and Yardi are the three main data providers for the multifamily industry.
And how does Yardi compare to CoStar? Is it less expensive, more expensive? Do you have more data points? Tell me a little bit about that.
Certainly. So I can't speak specifically for CoStar's pricing model or their data collection methodology, but from what I've heard from clients, we're generally comparably priced, in fact, a little bit cheaper for most clients. And we also offer a couple things that they don't. As I mentioned, expense comps. So we're able to suck in data from our property management software, aggregate and anonymize that data on the expense side, and then show you what a full P&L would look like, not only the rent and income, but what the expenses would look like in your general area. So we take the data from 5 local properties, aggregate that together, again, anonymize that and share that back with you and with subscribers. The other thing that we do is, like I said, we pierce the LLC, we go below the LLC level so that you get an actual contact name, phone number, and address for owners and for property managers. So if there's a deal you're working on, if you see, okay, there's a loan maturing, that's another factor that we have. We monitor maturing loans, so you don't have to wait for your broker to contact you about a deal. You can kind of source the deals yourself. So you can say, okay, Julie's property ABC there's a loan maturing in 6 months. I don't know who owns it, but I can look and see, okay, it's Julie Peterson. I have Julie's phone number. Okay, great. I'm going to call Julie. She might not even know she wants to take it to market. She might be trying to refinance or, might be struggling through some new financing terms. I'm going to call her. I'm going to say, Julie, I see you've got a loan maturing. Any interest in selling? You can do a lot of deals off market and get in at perhaps better pricing than if that deal were to go to market. So
what I really like about your product is that it gives you enough data so that you can take that information to your investors, have a reason. It's not something that you called the police department and found out the crime and you then looked on the web, and it's all in one place. It is solid information, and you can use it for possibly bringing down the price because you can use all of that data that's captured in one place. I mean, you really have robust information to supply to your investors and the seller and even the lender from our standpoint. So it is great. Can I take a poll, everybody? Who has used Yardi? Anybody use Yardi? Who used CoStar? And did you own the CoStar or did you have someone use it? Who owns CoStar? Who's borrowed it from somebody? Gotten it from?
I've owned it, but not anymore.
Okay. So.
Too expensive.
Too expensive. So Chris, I've got a question for you. Would there be an opportunity? Let me ask this of everybody. If the price was lower, would there be some interest of getting like something, just a snapshot? Or maybe you get a subscription that maybe you can look at a couple different properties. Would there be interest from everybody? Raise your hands if it was less expensive and it would offer a little bit less information, but still rich in quality. Anybody? Yeah.
Define less expensive.
So let's say you were looking at a market that you know, you want it analyzed. You don't want to do all the work. You know you want that market, but you're doing other things. You always leave certain things to the professionals, right? Wouldn't it make sense if you could contact somebody to do that, to do that part of the analysis, where they deliver the information to you based on all of the analytics that they have put together, they've collected, and provide you with a consultation? Would that be something, you know, where you have it all, it's all analyzed for you instead of you having to collect things? Would that be of interest to you? Yeah.
I had well, Rick Martin mentioned the one-off. Like, what'd be great is if we're looking at a deal, we analyze it, we like it, and we just want to make sure the data is exactly perfect. And that would be great. So if there was a one-off that we can just pay just for that particular market or maybe that property, that would be awesome. I don't know if there is something like that.
So Mark, we know how many deals that we get into, you know, we are analyzing lots and lots of deals. How many, would it be like a subscription? Would it be, you'd pay per analyzed deal? What would you need? Because sometimes you're looking at 10 deals.
I think, well, I think if I'm ready to put an LOI in, that's when I want a little more data. Like right before maybe I put an LOI in, or after an LOI is accepted, maybe the information would provide, so the Yardi information would give me a lot more insight and something that I missed. Because we do a lot of market data just, you know, with the free stuff, but you know, it would be great to have that if we're a little unsure. We're you know, we're out of state, so I'm out of state on pretty much the markets that I'm looking at. So I'm not really boots on the ground. So
right.
That
so
would be,
how much would you pay for that, Mark?
for a one-off?
Yeah.
I don't know. Maybe
500? 200?
200? Yeah, maybe.
So maybe 200 to 500?
Yeah, I think if a LOI got accepted, it really looked good. I think I'd pay that.
Yeah.
So
Neighborhood Scout does one. I don't think Neighborhood Scout is as robust as Yardi, but they do one-offs. And if I recall, I paid, it's pretty cheap. It was like, I want to say it was like 40, no, I think it was closer to $100.
Okay.
That's better.
So just trying to collect data. Chris, is that something that maybe you guys would be looking at? Or I know that from, you know, from people that are getting into this, it could be viewed as expensive. However, if you think about, this is your business, you are giving, you need this information for your investors. So there's got to be, the data has to be perfect. And it has to be analyzed. I'm not an analyzer. You guys might not be as good of an analyzer. If you could rely on somebody who can pull the data and analyze it, would it be worth it? Chris, could you think that there might be a product like that?
Yeah, absolutely. And this is, Julie, one of the great reasons why I appreciate being here, because part of my job is to bring new ideas and new products back to Yardi. And I think there's a huge group of investors, all of you included, that are saying, look, I've got one deal, I've got two deals, maybe I have 5 deals, but I can't afford to pay for your $5,000 or your $25,000 subscription. So it's great to talk to people like you and hear that there is demand for that, because I will absolutely bring that back and say, hey, can we create a separate product? Can we offer for $250 a comprehensive property detailed report? Or for $500, can we do a sub-market report with all the property details as well? Or whatever it might be. I'm just kind of talking off the top of my head. But this is great to hear feedback from all of you.
Can I add something to that?
Sure.
Yeah. So I typically would ask my property manager in whatever region for some kind of report, and usually it's either a CoStar report or a Yardi report. But when I do that, I kind of risk getting out there that I'm putting in offers on specific properties, and sometimes they're not on market. So it is something where I could see myself really wanting to be able to use that tool.
And the other thing on that, Patrick and everybody else, is that if you ask a broker, it may be steered toward selling that property that the broker wants to sell you. Is he giving you all of the information that is unbiased, right? So that's why I think there's a product out there where someone will analyze it for you. They've got the data, analyze it, and you guys could pay something, $250, whatever it is. If it's, maybe it's a subscription, so you could have maybe up to 5 analyzed deals over a 10 or 12 month period. I think there's a need for it. Yeah, I think so too, Tim. So I'm gonna kind of close this up. Once again, Chris, thank you so much. This was fabulous.
Absolutely. Thank you.
As we said, Chris will give you the top 10 markets. And I think, if you can reach out to him, ask him questions, don't overburden him, but, just reach out, let him give you the market study that he has, and then you have a contact, right? And we're going to have Chris come back maybe in a month and then another month, so he can analyze what's going on, so he can provide us some more information. Do you guys think this was helpful?
Oh, yeah.
Yeah. Rick?
Absolutely.
Okay.
Yeah, it was one of my favorites. I like numbers, so this is good stuff.
I think it would be more insightful after collections have passed in like May and June. Those numbers I'd be really interested in
Yeah.
Certainly, and I'd be happy to talk about that. Nate, I would point you towards the NMHC's website as well. They'll be updating it on a weekly basis. So for the next 2 weeks, you can see what April collections will be like. And then by the second week of May, they'll have that available as well. But I'd be happy to come back and talk about that data as well.
I definitely jotted that down when you said they had collection data. So I'm right there with you, man.
Yeah. So let's look towards the end of next month. We'll have you back, Chris. And I think there's a lot of interest here for whether it's a small package or individual. We'll have to talk about that. But you guys, thank you so much. Have a great week, the rest of it, and we'll see you. If I can help, let me know. Have a great night.
Thanks.
Thanks, Chris. Thanks, Julie.
Thanks, Julie.
Cheers.